Discover how China's $65 trillion property crisis creates hidden opportunities for Singapore REIT investors seeking stable returns in uncertain times. Hey friends, welcome back to the channel. I'm Iggy and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 800,000 reads. I've produced over 600 videos with more than 280,000 watch hours as of November 2024. I also focus on regional and world economy topics. Today we're diving into something that affects every Singapore investor: the massive changes in China's property market and what they mean for your REIT investments. Picture China's property market as a huge ocean. When waves form there, they eventually reach Singapore's shores. Right now, those waves are getting bigger, and smart investors need to know how to ride them. The first major impact hits close to home: Singapore REITs with Chinese tenants. Many of our prime office buildings house Chinese companies' regional headquarters. When these companies face challenges back home, it affects how much office space they rent here. Some are cutting back their space, while others are actually expanding. Recent data shows occupancy rates in China-based assets have dropped 8% compared to last year. This matters because rental income directly affects your REIT dividends. Let me pause here and ask, have you noticed changes in your local shopping centers or office buildings? Maybe more empty spaces or new tenants moving in? Drop a comment below because your observations help us understand these market shifts in real time. Now let's talk about industrial and logistics REITs. These are the properties that store and move goods between countries. China's manufacturing slowdown has created a ripple effect. When Chinese factories produce less, fewer goods move through Singapore's warehouses. Industrial rents in Chinese Tier 1 cities dropped 12% in 2023. For Singapore REITs with industrial properties in China, this means lower rental income. Think of it like running a taxi service. When fewer people need rides, your earnings drop. The retail sector tells another interesting story. Remember when our shopping malls were packed with Chinese tourists? Those days have changed. Retail REITs are adapting by bringing in more local brands and creating experiences that appeal to Singapore residents. It's like a restaurant changing its menu to attract more local diners when tourist numbers drop. Here's something that might surprise you. While some doors close, others open. Office REITs are seeing unexpected benefits. As China's property market faces uncertainty, more Chinese companies are moving their regional headquarters to Singapore. They see our city as a stable base for their Southeast Asian operations. This trend has helped maintain office occupancy rates in prime Singapore locations despite regional challenges. Let me share a real success story that shows how smart REIT management can turn challenges into opportunities. CapitaLand China Trust made a strategic move that paid off handsomely. They sold 3 shopping malls in smaller Chinese cities and invested that money in Singapore logistics properties. This decision increased their distributable income by 7% when many other REITs were struggling. It's like selling a property in a declining neighborhood and buying in an up-and-coming area. Timing and location matter. The numbers tell an important story. China's property sector makes up about 25% of their GDP. That's 1/4 of the world's second largest economy. New home sales there have plunged 40% since 2021. Singapore REITs with significant China exposure have seen their values drop by an average of 15% in 2024. But remember, in the investment world, the biggest risks often come with the biggest opportunities. Let's talk about what you need to watch out for. First, examine each REIT's exposure to China. Look at their property locations, tenant mix, and how much of their income comes from Chinese operations. Second, pay attention to currency movements. When the Chinese yuan weakens against the Singapore dollar, it affects REIT income from Chinese properties. Third, stay informed about Chinese property regulations. They can change quickly and affect your investments. Here's a practical example. If a REIT earns 30% of its income from Chinese properties, a 10% drop in Chinese rental rates could reduce your overall returns by 3%. That might not sound like much, but it adds up over time. Smart investors look for REITs that actively manage these risks through diversification and strong tenant relationships. Now, Let's create your action plan. Start by reviewing your REIT investments. Check their annual reports and presentations to understand their China exposure. Look for REITs that are actively managing risks, like CapitaLand did. Keep some cash ready for opportunities, but move carefully. Consider averaging into positions over time rather than investing all at once. The property market moves in cycles, and right now we're seeing significant changes in China. This creates both risks and opportunities for Singapore REIT investors. The key is to stay informed, diversify your investments, and understand what you're investing in. Before we wrap up, here's a bonus tip. Look for REITs with strong balance sheets and low debt levels. These REITs are better positioned to weather market turbulence and take advantage of opportunities when they arise. They're like ships with strong hulls, better equipped to handle rough seas. Strong balance sheets and low debt levels. These REITs are better positioned to weather market turbulence and take advantage of opportunities when they arise. They're like ships with strong hulls, better equipped to handle rough seas. Strong balance sheets and low debt levels. These REITs, if you found this analysis helpful, you'll definitely want to check out my video on 5 investing moves for 2025 you can't afford to ignore. You'll find the link in the description. Don't forget to hit subscribe and the notification bell to stay updated on more investing insights. Remember, successful investing isn't about avoiding all risks. It's about understanding and managing them wisely. I'll see you in the next video.